Hello, everyone, and welcome to this investment update for members of the Western Pension Plans. My name is Martin Bélanger, and I'm the Director of Investments at Western. This presentation will focus on investment results for 2020. If you are looking for details on the decisions made by plan members in 2020, please see the other recorded presentation prepared by my colleague, Cara Bordeaux. Before we start, I would like to stress that one of the goals of this session is to educate you on the Western pension plans, but that ultimately the decisions are yours to make. If you need additional help, you can find support through Sun Life, and you may also wish to consult a financial advisor. Here's the agenda for today's session. I will first provide a performance review for 2020, and I will then review the impact of inflation and interest rates on pension investments. Here's a quick summary of 2020. We've experienced positive returns for most asset classes during the year. However, the year was fairly uneven, with large stock market declines in February and March, followed by a significant rebound due to large fiscal and monetary stimulus provided by governments and central banks. For example, the S&P 500 dropped by 35% between February 19th and March 23rd, and ended the year with an 18.40% return in local currency. The S&P TSX dropped by 37% over the same horizon and ended the year up by 5.6%. We also experienced significant divergence in returns between value and growth stocks. Growth stocks are companies that experience or are expected to experience significant growth in revenues and earnings, while value stocks are companies that are considered to be undervalued based on some metrics, such as price to earnings ratio. Growth stocks outperformed value stocks by 35% in the US during 2020. However, value stocks started to rebound in November with positive news around vaccines. We also experienced strong fixed income returns because of interest rate declines. For example, the FTSE Canada Universe Bond Index returned 8.68% in 2020. Unfortunately, money market securities are yielding next to nothing at the moment because of those interest rate declines. We are also seeing high stock market valuation. The cyclically adjusted price to earnings or CAPE ratio in the US just reached 36.6, its highest level since the tech bubble. In addition, we are experiencing economies that are reopening. For example, GDP growth forecasts for 2021 are fairly strong at the moment. According to Capital Economics, the GDP growth forecast for the entire world is 6.3%, 6.5% for the US, and 6% for Canada. And finally, will we get an increase in inflation based on all the fiscal and monetary stimulus provided by governments and central banks? And I'll cover that later during the presentation. This slide shows the evolution over time of the CAPE ratio that I discussed during the previous slide. For the S&P 500 as calculated by Robert Shiller. At 36.6, stocks are now more expensive than at any other time in history beside the end of the tech bubble. Here's an overview of the performance of the 13 investment options offered to members of the Western pension plans. Overall, we had a very strong absolute returns for every investment option in 2020. The one option that is not listed here is the guaranteed daily interest account. As of April 23rd, 2021, the GDIA offered a rate of 0.8%. In the next few slides, I will dig a little deeper into some of those investment options to explain what went well and what went wrong. I will start with the diversified equity fund and the diversified bond fund. Those two funds are very large and include several components that are also used to provide some of the regional strategies made available within the pension plans. For example, the diversified equity fund includes the Canadian equity fund, the non-North American equity fund, and the US equity hedge fund. Let's start with the diversified equity fund. The fund had a strong net return of 11.8% in 2020, outperforming the benchmark return of 11.4%. This chart looks at the benchmark and then organizes by magnitude of the impact on performance, beginning with the largest detractors, moving to the largest contributors. There were a few themes in the portfolio last year, and they significantly impacted performance. First of all, as I mentioned earlier, growth outperformed value. In addition, low volatility strategies significantly underperform. As a result, managers with a growth investment style, such as CCNL, MFS, William Blair, and T. Rowe Price, all outperform their benchmark, and some by quite a margin. On the other hand, value managers like AB Canada, Oakmark, and Beutel Goodman all underperform. The Winwise US managed volatility strategy significantly underperformed last year, and that strategy was subsequently terminated and replaced by a global low volatility equity strategy managed by Fidelity. Investment management fees vary by fund option, but were 0.39% on average for the diversified equity fund for 2020, which is fairly low. Overall, out of 10 investment strategies, 4 mandates underperform, 5 outperform their benchmark, and 1 index fund matched the benchmark return. Looking over a longer horizon, the Beutel Goodman Canadian Equity Fund, the AB Canada International Value Fund, and the Oakmark Global Equity Fund are the only 3 mandates underperforming their benchmark over 5 years. Finally, the Joint Pension Board has implemented a few changes after the end of the year. In addition to replacing the Winwise US Managed Volatility Fund with a global low volatility equity strategy managed by Fidelity, a global equity fund managed by BlackRock was added and represents 10% of the portfolio. The Canadian equity allocation dropped from 30 to 25%, and the allocation to international equities dropped from 16 to 10%. Let's move on to the Diversified Bond Fund. The fund had a net return of 5.5% compared to a benchmark return of 7.9%. The 2 mandates managed by AllianceBernstein struggled and both significantly underperformed during the first quarter of 2020 because of a widening of credit spreads, but rebounded thereafter when credit spreads tightened. The mandate managed by Romspen had a nominal contribution to the return of the Diversified Bond Fund, and the BlackRock mandate matched the benchmark return as expected. Investment management fees were 0.29% for 2020 for the Diversified Bond Fund, and all mandates except the AB Canada Core Plus Advanced Fund have added value since inception. This chart provides the performance of the 2 balanced funds. The performance of the Balanced Income Fund and the Balanced Growth Fund is directly linked to the performance of the Diversified Bond Fund and the Diversified Equity Fund, as the Balanced Income Fund invests 70% in the Diversified Bond Fund and 30% in the Diversified Equity Fund, while the Balanced Growth Fund invests 30% in the Diversified Bond Fund and 70% in the Diversified Equity Fund. Both funds underperformed their benchmark, although they posted strong absolute returns because of the underperformance of the Diversified Bond Fund. Now let's look at the performance of the other funds that were not covered during the review of the Diversified Equity Fund and the Diversified Bond Fund. They all had performance in line with expectations. The money market fund had a return of 0.74% compared to 0.86% for its benchmark. The long-term bond fund had a return of 11.62% compared to 11.9% for its benchmark. The US Equity Hedge Fund had a return of 16.24% compared to 16.32% for its benchmark, and the Socially Responsible Global Equity Fund had a return of 14.37% compared to 14.77% for its benchmark. In the next few slides, I will cover inflation expectations, the impact of inflation on the pension plans, and ways to mitigate the impact of inflation. First of all, inflation is a rise in the overall price level of goods and services in the economy. However, there are concerns that the large fiscal and monetary stimulus that we've just experienced may cause inflation rates to increase. Inflation is expected to increase in the short term because it's measured over a low base achieved at the beginning of the pandemic in March 2020. However, it may prove to be transitory in some markets such as Europe, but may persist in other markets such as the US due to large stimulus. Also, a relatively stronger banking sector, lower household debt, and deglobalization are more likely to produce inflation than the policies implemented after the global financial crisis, as consumers are more likely to spend than to repay their debt. In addition, the Federal Reserve in the US moved from a 2% inflation target to targeting an average of 2% over time, which means that it will overshoot its 2% inflation target from time to time. Finally, there's some consensus among economists that inflation is about to rebound, but will still remain low by historical standards. Now, how to deal with inflation? Well, in order to ensure that pension accounts are not eroded, you need to generate a positive real rate of return. That is, you need to have a return that exceeds the rate of inflation. As the charts demonstrate, stocks, bonds, and cash have all outperformed inflation since 1934 in Canada and 1926 in the US. However, with 91-day T-bills yielding 0.09% in Canada, 10-year Canada bonds yielding 1.45% and 30-year Canada bonds yielding 1.89% as of April 15, 2021. And with equivalent yields in the US, it's unlikely that cash and bonds would provide positive real returns in both the US and Canada if inflation were to spike. As such, equity is the best asset class to protect the portfolio against inflation. Now let's look at what external investment managers on the Western Pension Plan can do to deal with inflation. A study made by Ned Davis Research found that the energy sector has been the best performing sector of the S&P 500 since 1972 during periods of high inflation, with a 13.9% return and an outperformance observed in about 78% of the cases. The communication services sector has also done well with a 9.5% return and outperformance observed about 2/3 of the time. As such, our managers may tilt their portfolio towards sectors that do better during periods when inflation is high in order to protect the portfolio. This next slide shows the sectors of the capital markets that tend to do best under various scenarios of inflation and economic growth. Some of these strategies may be implemented by managers on the Western Pension Plan, while others are available outside of the pension plans. When inflation is combined with strong economic growth, real estate, infrastructure, value, and cyclical equities tend to do well, while real return bonds, commodities, gold, and floating rate notes tend to do well in inflationary environments, regardless of economic growth. Equities in general tend to do best during periods with low inflation and strong economic growth, while during deflationary periods, cash, government bonds, and high-quality corporate bonds tend to do well. Now, what to expect with interest rates? Well, expected inflation typically impact interest rates. Typically, higher inflation would cause interest rates to rise. Bonds are normally negatively impacted when interest rates go up. Stocks are also typically negatively impacted when rates go up, but the relationship is not as straightforward. On one hand, it's more expensive to borrow. Consumers have less disposable income to spend, and companies pay more in interest expenses, which both contribute to negatively impact earnings. Higher interest rates increase the level of the discount rate used to value companies. Sectors where profits are expected to be realized later in the future, such as information technology, are more negatively impacted by an increase in interest rates. Also, if interest rate increases are a signal that central banks are about to put the brakes on the economy, it's also a negative news. On the other hand, if an increase in interest rates is perceived as an improvement in market expectations, equities will tend to go up. And finally, the level of interest rates, in addition to direction, also matters. If rates remain low, even if they're increasing, it's generally positive for the stock market. Most of the levers to deal with an increase in interest rates are at the investment manager level, but members of the pension plans also have the options to change their asset mix. For example, you can reduce your allocation to fixed income funds, or you can reduce the duration of your portfolio, which means investing in securities that have a shorter maturity. For example, the money market fund has a lower duration or maturity than the Canadian bond fund and the diversified bond fund, which both have a lower duration than the long-term bond fund. Also, depending on their investment style, some equity managers may choose to overweight the financial sector, as banks tend to do well when interest rates increase. They may also overweight value stocks that also tend to do better in a rising rates environment. Bond managers may overweight corporate bonds, which would benefit from a credit spread tightening, and invest globally to better diversify the portfolio. Outside of the pension plans, a deposit laddering strategy would take advantage of rising rates. And this is the end of my presentation. Thank you for listening. If you have any questions about your pension plan investments, please feel free to contact me at the address on the screen.